Hey, good morning. Hope you're doing well today. This is Jerry with Wealth Dynamics coming to you with a quick video this morning to give you a look back at the 1990 recession. Now, I've got to admit, I was only born in 1992, so I wasn't there. But I did study it and I looked at what happened, and I want to share with you what I learned about the 1990 recession with the hopes that we can grab some information about what happened then and maybe use some of that on the future recession and figure out what's going to happen next and what do we need to do in light of that. So if we rewind all the way back to 1990, a couple things happened, okay? So we had a recession going on. The 80s basically were wrapping up, and there were 3 or 4 major things that really caused the recession in 1990. The first one was actually the Federal Reserve. The Federal Reserve Bank. Now, those of you that don't know what the Federal Reserve Bank is, the Federal Reserve Bank is not federal and it doesn't have a reserve. It's actually a private finance corporation that basically supplies the money to the United States. Okay, so the Federal Reserve Bank essentially manipulates currency, supply and demand, interest rates, and they do that in party with Treasury and Congress and the United States government. But it is a private organization, so let's not think it's part of the government and that they're there to serve. They're there to make money, okay? Just like any private corporation is. So the Federal Reserve, they actually increased interest rates moving from the late 80s to the early 90s because they were worried about inflation. So if you guys were around in the 80s and 90s, you guys remember the high interest rates, very high interest rates. We're talking like 10, 12, 13, 15% interest rates. And that was in hopes to slow down the economy. They thought that there was a concern of inflation and that would slow down the economy and kind of cool things off to defeat an inflationary environment. Now, that kind of backfired. It slowed things down a little bit too much. But I do think that they accomplished what they were looking to accomplish. After the 90s recession, we didn't have another one for 10 years. So, long term it worked. Short term it did cause a recession. It did cause a slowdown. And that's something to kind of recognize. Now, the other thing that happened is we were just wrapping up the Cold War. Okay, so we had the Cold War going on with Russia. That was causing some economic turmoil as well. In addition to that, in the late 80s, about 1/3 of our savings and loan associations went insolvent. That's one of the big ones that happened. Savings and loan associations going insolvent, about 1/3 of them. That's a lot. That's over 1,000 associations going broke in the late 80s, early 90s. And then finally on top of that, we also had the 1980s crash. We had a lot of stuff going on in Wall Street with insider trading, best interests, just kind of like and Wall Street's always been that way, kind of a foggy environment as far as ethics go, okay? So to summarize, we had the Cold War happening, okay? We had interest rates going on. We had the savings and loan associations going broke, and then we had, Wall Street doing their thing. Lastly, we had oil. Oil prices went very, very low. That also caused the economy to be in a slump. These 4 or 5 things started the 1990s recession. Now, again, if you were in the market, the stock market in the 1990 recession, you lost money. Okay, I'm going to keep going back to this every single time. If you were in the market during the 1990s recession, you lost money. And same thing with the 2000 through 2002, same thing with 2008. There's no coincidence there. And the reason why is those are correlating assets, meaning in a boom, they do well. In a bust, they don't do well. And in a boom, a lot of times the asset doesn't actually do well. Like right now, the stock market's ripping. It's not actually ripping. It's just the dollar is that devalued, that it makes everything seem like it's overvalued when really all it means is it takes more dollars to buy the same thing. That's the real representation of what's going on. So what do you do if you're in 1990? Well, if you were in oil, you probably would have got hit. Okay, if you were in the stock market, you probably would have gotten hit. Do you want to know what didn't lose money in 1990? The sacred account. The sacred account actually did. It was either 11 or 12% that year. So think about it again. Everyone around you is losing money, yet you're making 11 and 12% that year instead of losing. Like, think about the contrast. Lose money or make 12%. Which one would you pick? I would pick the 12%, hands down. Now, if you're looking at the next recession, it's going to be the same trends, guys. It's going to be economic stuff happening, political stuff happening. The Federal Reserve is going to try and interfere just like they always do. They're going to screw it up worse than it already is. You're going to see Wall Street being unethical just like they always do. And there's going to be some sort of political thing going on as well. Those are always the mixes of a recession. Yesterday, we talked about 2000 through 2003. We had political stuff going on. We had a crisis, 9/11. We had Wall Street being unethical, okay, which was the companies misreporting their earnings and committing financial fraud. And then we had economic calamities with these tech companies going bankrupt because they didn't really have a business. It was a brand. It was a website. So these are the common trends, and you're going to continue to see these over and over and over. In the next recession, the same trends are going to be there. It's just going to be different players. And some of the same players, to be honest. So if you want to avoid losses, then you really need to be focusing on non-correlating assets and inversely correlating assets. I'm going to continue to preach this. It's not rocket science. If the market goes down, you want to be in something that either doesn't go down or it goes up instead. And that's a very simple thing to set up. So real quick, if you are watching this today and you would like to learn more about all of the recessions that we've had over the last 5 that I've been talking about this last couple of weeks, you would like to learn more about the non-correlating and inversely correlating assets versus just doing the correlating stuff that everyone else is currently doing, I did build a free membership site that I want to give you access to. So before I forget, I just dropped it in the comments here. It's jerryfetta.com/recession. jerryfetta.com/recession. It's a 6-module free membership course. You don't need to put in your credit card number. You don't need to buy anything. You don't need to sign up for a subscription to bill you later. None of that stuff. Literally, you click on the link, you set up a free profile, you gain instant access, and you can go learn, train, and get educated. So if you want access to that, that's on the link in the comments, or you can go to jerryfetta.com/recession. Again, tomorrow night, we're going to be doing our wealth creation course like we do every Friday, and I will be going through a 4-point action plan on how to win and make money during the recession. Very simple. I hope you tune in. Again, that's tomorrow night, 6 p.m. Alaska time, 9 p.m. Central time. Thank you again. Make sure you do like, share, and subscribe. I will talk to you soon.